Here's 10 ways to save on capital gains without relocating overseas. And the first way is by claiming business asset disposal relief, formerly known as entrepreneur's relief, which reduces the rate of CGT you pay down to 14% on the first million, going up to 18% on the 6th of April 2026. The next is rollover relief, and you can defer the amount of CGT that you pay by qualifying back into a qualifying asset. This is great for entrepreneurs that want to use the proceeds to go back into another active business venture or other investments. The next one is holdover relief, and this is if the shares are gifted, you don't actually have to pay the CGT until the recipient then disposes of that in the future. Next is substantial shareholders exemption. And if you sell a subsidiary and you're part of a qualifying group, then you don't have to pay any capital gains at all if your subsidiary proceeds are then going up to the holding company. So this can avoid completely any capital gains being payable. The next one is investors relief that potentially brings down capital gains to 10%, but qualifying criteria applies. The next one is EIS or SEIS. If you invest some of your proceeds into these schemes, which is essentially investing into businesses that are on growth curves and need investment, it's great for entrepreneurs looking to diversify their portfolio and also defer the element of capital gains due on the amount that they invest into these startups. The next one is sale to an employee ownership trust. More than 50% of the entity needs to be sold. 0% capital gains is payable. It benefits the team, and it's great if you want a long-term legacy business that continues to grow and flourish, but also have a partial exit before the eventual day comes that you exit the whole venture. The next is earnout and deferred consideration structuring, but you need to be really careful on anti-avoidance here. The next one is placing shares into an offshore or UK trust, but serious tax planning needs to be done here to execute this right. And finally, you can transfer shares to your spouse pre the sale to spread over the gain over multiple different allowances and sets of reliefs to overall reduce the amount of CGT that you will pay on this exit. And the lesson here is no, reducing capital gains isn't something that you cannot do. We work with many entrepreneurs to plan pre-exit and post-exit. So if you need help, just let us know.